Let us help you reach your peak in retirement. It's time for Retirement Elevated with Sean Lee.
Hey everybody, welcome into the podcast. Time for another edition of Retirement Elevated with Sean Lee and myself here to talk about a portfolio expectations, return expectations by investors for the new year. Are they too high? Are the expectations too high? So Sean and I are going to riff on this a little bit from an article we saw in Investopedia a little bit back. So Sean, what's going on, my friend? How you doing this week?
I'm doing well, man. Just the calm before the storm with the kids and their activities.
Oh, yeah, very true, very true. So check this out. So you and I were talking about this a little bit, right? I know you've seen this, obviously. Are expectations too high by investors for portfolio return? And this was kind of an interesting article. We'll put a link to it in the show notes for people to check it out. But tell us a little bit about the article, and then also just in your practice, like, what do you see? What do you take from it?
Yeah, this was actually sent to me from Chris Cordova in our office, one of our senior advisors, and he's like, hey. He just texted over. He's like, "Hey, check this article out. There's some pretty interesting tidbits in the article, and what this article was, it was a post from a group called Visual Capitalist, and they polled 8,550 investors. They polled 2,700 advisors, and they wanted to really get down to what the focus of the poll was on." Domestic portfolio expectations. So what do you think that you should be earning and in your portfolio? And they did this globally. It wasn't just in the United States. It wasn't just here domestically. This was a global poll because they wanted to get viewpoints from people in different countries with different ideologies or whatever it may be. And surprisingly, the gap was the largest in the United States.
Yeah, so the expectation. So we're wait, the United States was expecting more?
Yeah, so the average investor, what they were expecting in comparison what advisors expected return-wise was a pretty big gap. So to give you an idea, the S&P 500 has returned 11.5% annually, average returns between 1928 and 1922, so like 94 years. Or 2022, excuse me. Yeah. And now that return has come from approximately 6% of it's come from growth, and then the rest of it has come from dividends, right? So you've got 11.5% average annual return over a 94-year period. 6% was from capital appreciation. Approximately the rest was from dividends. So the average advisor's expectation was 7%.
Okay.
That a portfolio should be able to consistently earn 7% on average.
It's pretty darn good, I would think.
When you look at average inflation over the same time, it was closer to 2.3%.
Yeah, and even if we were a little higher at 3 or 3.5, not some of the crazy stuff we saw, but even so, that's still pretty good.
You're still making money.
Right.
You're still outpacing inflation, which is the whole goal in retirement. Create income, outpace inflation. The average investor in the United States expected to outperform the stock market by 4%. They expected to get a 15% return on average.
Well, like I said, the funny part about that, right, is that Americans having, expecting more. We're a little spoiled, let's be honest, right? But some of the numbers, if you're looking at some of this too, there's some other countries where it was fairly wide. Japan, not quite as wide, but it looked like they were 13% on their expectations, but was getting about 8%, right? So still a split, but not quite as far as apart as ours was.
Yeah, and the global average was, the global average for advisor expectations was, 9%.
Okay.
Investor expectations were closer to 13%.
Okay.
So there's still a gap, but if you look at it, the S&P 500, which is the largest index in the world, 11.5% was the average return. The capital appreciation of that index was 6%, and investors all over the world are expecting 14.
Yeah. Well, it's kind of interesting how this breaks this down a little bit too, right? So there's a lot of information here, but there's the arithmetic average, the S&P over total different periods. And it's a little interesting the way it kind of chops it up. But from 2009 to 2023, it was like 12.13%. which again, pretty darn good. We had that. Obviously, we're on pretty good tear there, right? So,
Right.
so what do we do about our expectations? I mean, I think working with an advisor, part of that is how do you manage that, not only for ourselves as the client, right, but how do you guys help us manage that as the advisor?
Well, there's a problem here, right? So a lot of advisors lead off a return. They talk about return, return, return.
Sure.
Oh, here's your current portfolio. You're getting 8%. Oh, I can do better than that. Here's this portfolio can do 9. And then they go in and that's how they bring a new family in. And when they don't hit that portfolio, all they've done is lead off of return. And when the returns aren't there, or there's the next mousetrap that's going to do better or whatever it may be, now that client leaves. Our philosophy is a little different. So when you start to look at how do you get to your end goal, and I just had a conversation with a family actually yesterday, and they said, hey, we're pulling out $60,000 a year from our portfolio.
Mm-hmm.
We've got $1.5 million. We're invested in the S&P 500, and we're invested in small companies, indexes. But we have no income strategy. The returns have been okay. They were great in 2023. They were really subpar in 2022. That scared us because we're still continuing to pull out income. So returns are only part of the problem, or part of the solution to the problem. The first thing that we need to make sure that we do is, all right, well, if you've got to create a certain level of income, how do you want to create that income? So let's look at all the choices, the options to create income, whether it's protected money or whether it's through dividends, whatever it may be. Let's come up with that solution first. And then let's figure out how your investments need to be allocated, and where you need to place your money. And by starting to put purpose to our assets, purpose to the dollars that we have, we can then create more clarity, and we don't feel like we need to run and get 15%. Maybe our expectations temper a little bit because we're more comfortable with our incomes, and now we're back to reality.
Very interesting. Yeah, I mean, there's a lot going on, obviously, in that, and trying to manage those expectations. And obviously, when the industry sometimes suffers from a bit of the let me get you in the door by talking about returns, that's not always the best avenue to take, right? When you really want to figure out what do I need? What is my plan? What do I need to make my lifestyle go? Like, we all are greedy and want more, but what do I truly need to make my lifestyle go? And then let's build a plan that accomplishes that without necessarily, having those expectations through the roof.
Exactly. And you look at, a lot of the families we work with know how much they need monthly to live on, to be comfortable. As long as we're accomplishing that goal and we're still outpacing inflation, we're getting the returns that are expected. Mm-hmm. That's a win-win. But if you think about it this way too, like, if you're retired and you've got the incomes that you want, the incomes that you need, and you're able to do all of the things that you want to do without a big concern about where cash flow is going to come from or how you're going to get money out if there's an issue, is an extra $100,000 or $50,000 in your portfolio value going to turn the needle for you? Probably not.
Yeah. Well, we'll wrap it up with this. So this one gentleman here, this Jeremy Grantham, noted that he's talking about bubbles turning into super bubbles, right? And super bubbles, which is interesting. I hadn't really heard that term, but I guess that makes sense. So, the U.S., talking about a number of them, like the U.S. had obviously a super bubble in 1929. That was the big crash. 2000, Japan had one in 89. Then, of course, we had the housing super bubble in the 06 to 07, 08 era there. So it's talking about currently the U.S. is in its fourth super bubble of the last 100 years. So I'm assuming, since there's only three mentioned here, 29, 2000, 2008, he's talking about currently, right? And so there's a lot of, are we in a bubble because of the COVID spending still? Is there all this kind of stuff that's been, because it takes more than just a couple of years for this stuff to work out. But it's interesting, Sean. I guess my question is this. We've heard for, 2 years now, recession was coming, but yet the market seems to be doing all right. And it's very confusing to folks. Like, is the recession coming? Have we overspent? It's really hard to figure out what in the world to do.
Well, and we look at 2022 as a good indicator. I mean, the Fed did something that they've never done in history, and they moved away from quantitative easing. They raised interest rates 6 times, I think it was, in 2022.
Right.
and took us from a zero interest rate environment to where we are today.
And now they're talking about maybe cutting a little bit this year.
Slowly but surely cutting, but the only way to really maintain like huge levels of growth is to just stay at that zero interest rates forever and keep quantitative easing. Well, that doesn't always work well for our economy because then you become overvalued, overinflated. And the 2022 correction was long run, it's going to be good. It caused some pain short term.
Sure, right.
But at the same point in time, if you knew where your income was going to come from and you weren't tied into just indexes or whatever, and you'd have to sell off shares to create your cash flow,
right,
and you had a plan, you made it out alive.
All right. Well, so it's all about a strategy, right? It's all about having a strategy, having a plan, and working your way through this and managing expectations. Clearly a big piece of that. So if you got some questions, need some help, as always, don't forget, reach out to Sean and his team at elevatemyretirement.com. That's elevatemyretirement.com. And don't forget to subscribe to the podcast on Apple, Spotify, Google platforms. I guess it's all on YouTube now. So, yeah, check us out there and subscribe to the show. And you can find, again, all that information at elevatemyretirement.com. We'll put the article in the show notes for folks to check that out as well. There's a lot of graphs and a lot of charts in there, some interesting stuff. Might get a little deep here in places, but feel free to check that out. And Sean, thanks for hanging out, brother. I always appreciate it.
Hey, thanks, man. Appreciate you.
Always good stuff, and we'll be back with another episode here in a couple of weeks on Retirement Elevated with Sean Lee.
Investment advisory services offered through Elevated Capital Advisors, LLC, and SEC Registered Investment Advisor.